really glad to have you join us. Welcome to this exciting webinar. We're really pleased and excited to be hosting a group of really prominent speakers who've done some excellent work in the catalytic capital space. And AVPA is in particular really excited to be partnering with the Catalytic Capital Consortium on this webinar that discusses how investors and other asset owners can manage, maximize, and catalyze the power of catalytic capital. This webinar will be showcasing findings from Africa-focused research projects that C3 supported. Panel experts will discuss how key considerations and lessons from their recent research have been put to work in developing evidence that will inform the future of this particular line of work. This body of work strengthens the evidence base on catalytic capital and focuses on answering questions such as what role does it play, how and when is it needed, and the results and impact it can help create. This webinar will also draw out action-oriented findings and conclusions by identifying best practices for investors in Africa. We're particularly excited as AVPA to be co-hosting this particular webinar because this is a topic that's very close to us. If we look at our mission of mobilizing capital for impact, we strongly believe that the world of impact is not short of money, but short of risk capital. And catalytic capital plays a critical role in this webinar, in the process of catalyzing capital. And this webinar really focuses on the African efforts that are being made to collect the evidence of what is possible on the continent. So we're excited to have a really exciting range of partners. We'll listen to all the people you're seeing on the screen. Kirsten from Tash Consulting Services, Carla from Marcelli, Remy from Open Capital, Alexis from INP, and Amalate from Impact Investing Ghana. I'll let them introduce themselves in a short while, but before we go there, we will go to the slide with the agenda for today. We'll welcome Stacy to make some opening remarks before we proceed to the speakers, who in the process of introducing themselves will also carry us through their slides and presentations. And we'll take questions from the audience throughout the call. So please use the chat for that particular purpose. And we'll close with a couple of closing remarks from Umi as well. So I highly encourage you, please use the chat function for your questions. But as we get into the program, and as Stacey welcome does the opening remarks, can you please let us know in the chat your name, your organization, and which city or country you're dialing in from? So your name, your organization, and which city or country you're dialing in from. But without further ado, Stacey, over to you.
Thanks so much, Frank, and to AVPA for hosting this webinar and for stepping up to present this to your community and beyond. Thank you to our grantees who will be speaking today, who did this very important research work and who are partners in engaging investors to provide more catalytic capital, supporting critical social and environmental needs. And of course, thank you to everyone joining us today for this webinar. I'm Stacey Shao, Program Officer for the Catalytic Capital Consortium, or C3 for short. And just a quick background on C3. C3 is an investment, learning, and market development initiative that was launched in 2019 by the MacArthur Foundation in partnership with Omidyar Network and the Rockefeller Foundation to promote greater understanding and more effective use of catalytic capital through working with investors, and in recognition of the essential role of catalytic capital in realizing the full potential of the impact investing field, including achieving the Sustainable Development Goals, the SDGs. And over the years, C3 has grown to build a large community of investors, fund managers, practitioners, and other actors playing various roles in the catalytic capital ecosystem and spanning across many countries. C3 worked with, again, as Frank mentioned, a cohort of 14 grantees that analyzed the uses of catalytic capital across different markets, regions, themes, and topics around the world, drawing from experiences from around the world, looking at outcomes and lessons learned, all to help strengthen the evidence base for the field. And we wanted to host a series of webinars to give these 14 grantees some broader visibility to their work and to their C3 research projects. subgroup of US-focused grantees within this cohort presented in a webinar that the Mission Investors Exchange held a couple of months ago in March. And today's webinar is the second of our series. So you'll hear from another subgroup of the 14 grantees today. We're very much looking forward to having you all hear from this wonderful subgroup on the research that they've done, their findings and implications. And we do hope that you all will find the insights helpful as you consider your own work around Catalytic Capital. And please look out for the final webinar in our series, which will feature our remaining grantees in this research cohort. But I'll mention one more thing before I turn it back to Frank. We do encourage you all to please visit the C3 website, where you can learn more about C3 and the work of our grantees and partners. You can also join our community there and also sign up for our newsletter to stay in touch. But thanks so much, and back over to you, Frank.
Stacey, thank you very much for those opening remarks. To everyone on the call, once again, it's exciting to see the diversity of people who've dialed into this call. So please use the chat to let us know where you're dialing in from, your name and your organization. Without further ado, I will welcome our first speaker, Ama Latte from Impact Invest in Ghana. Ama sadly has to leave after about an hour. So if any of you has questions for Ama, can you please put them in the chat? We'll try and get her to address as many of them as possible. So Ama, over to you. Ama, can you hear us? You're muted.
Hello, Frank. Yes, I can now.
Okay.
Apologies, I couldn't earlier. Hello, everyone. My name is Ama Latte, and I am CEO of Impact Investing Ghana. Impact Investing Ghana, with the Catalytic Capital research, sought to figure out how do we mobilize catalytic capital at scale to fill the 331 billion SME financing gap in Africa. And it's helpful to understand a little bit about who we are and what we do to appreciate why this was the problem we were trying to get evidence to help us solve. So Impact Investing Ghana is an ecosystem enabler. And our goal is to really drive what we call radical collaboration in Ghana and across Africa, especially in West Africa, to unlock funding for sustainable growth, for jobs, for economic transformation, and for impact. And we do three things. One is conduct research to identify gaps and to drive action. And that is what the C3 research was seeking to do. And then once you identify gaps, we then build capacity when the gaps have got to do with human capacity, but also bring together different people in the ecosystem, sometimes government, international development, a fund, to fill those gaps. And so I'll share a little bit about what we've done post-research with those findings around building capacity, increasing collaboration, and filling gaps. And ultimately, we want to unlock funding. We are trying to unlock $1 billion in dollars for small and growing businesses in West Africa. We are part of a network of field building organizations across the world, GSG Impact, and in Africa, we are in 5 African countries and come together as the Africa Impact Investing Group. So that gives you a bit of context of us, field building organization, but really looking to help support the setup of vehicles that will unlock funding. So what did we find out? What we did was a longitudinal study of all SME financing programs in Ghana that had happened between 2005 and 2021. And we found $1.73 billion worth of funding in these programs, of which 1.16 billion was investments. That was investments going to SMEs. And 949 million of it was supposed to be catalytic. What do I mean by catalytic? It was capital that was declared that it wanted to take on more risk so that it could unlock additional capital and so that it could solve a problem or be innovative. And so this was money that was very clearly intended to be catalytic. And what we tried to do in that research was to see if the evidence showed that this money actually was catalytic. Did it unlock additional funding? Did it solve the problem? Did it innovate a new structure? Was it successful? And we found that a lot of the programs did not actually track the funding unlocked. They tracked their own impact, but not so much the impact of the funding unlocked. But for those who did, there were 10 of them, it was 552 million in additional funding. It was about 5 times the total value of those 10 programs. And if you looked on average, it was 3 times to 7 times the funding deployed. So clearly, some investors, very determined to be catalytic, were very successful in unlocking additional funding. And the research saw significant increases also in revenues of the businesses that were invested in, employment, access to finance, all the things you would expect. So then the question, if we can go to the next slide. So the question then becomes, why? What made them succeed? And I think that will be shared in the links, the link to the full report that will go into detail about all the things that these funds did to succeed. But I want to highlight 3 of them. And the first thing, and they are all pretty obvious things, but it's shocking to see that so many of us in this ecosystem don't always do these things. So the first one was that if you want to unlock financing from someone else, you want to co-invest with them, you're planning that they will do follow-on investments, then you need to include them in the design of your vehicle right from the beginning. And so the organizations that were successful in unlocking capital had an ongoing relationship, conversations with the counterparts that they hope to unlock funding for. The second thing was using flexibility, longer tenures, and things like, very occasionally, was actually only 8% of these vehicles that had concessionary rates. So 92% were market rates. But those who had concessionary rates were targeting especially hard to reach populations or especially underserved populations. And then the third piece was really around having ticket sizes that aligned with the needs of SMEs. And across Africa, that tends to be a little smaller than the average investment size that you would find. And so these are things for people, for catalytic capital providers to explore as they design vehicles and seek collaborations. But the research also highlighted some opportunities. And some of them are challenges, but I prefer to think of them as opportunities. So for example, the biggest risk that we saw these programs having, these vehicles, was currency risk. And it's not surprising looking at currency performance across Africa. So innovations, one big gap that catalytic capital could fill is financing innovations around affordable currency hedging. One opportunity that we saw was pension funding as a viable local pool of funding. In Ghana, it was about 5 billion at the time. In Nigeria, about 32 billion. Because of currency depreciation, that's come down a bit. But it's still a viable pool. And you'll see when I talk about what we've done, that unlocking this opportunity is something that we've been able to focus resources on since the report. The third opportunity was fund of funds. Funds of funds are vehicles that can mobilize money at scale. And we are beginning to see across Africa that they can offer de-risking and build pipelines that intermediate to allow for capital to be deployed in smaller chunks, but to be aggregated at scale. And I'll just jump to the 5th point, which is for catalytic capital to work, you need a full ecosystem of skills that are working alongside capital: transaction advisors, placement agents, enterprise support organizations building pipeline. And so where these begin to thrive, we see that catalytic capital has more chances of being successful. And in the last slide, I'll share with you some of the things that we've done since the research and invite you to participate in some of these. So based on the insights on the need for collaborative design, we've been working on the design of 2 vehicles. One is a 75 million vehicle to unlock local pension funding for small and growing businesses. We have appointed a fund manager and are on track to a first close at the end of this year. The second is more early stage. It's an innovative vehicle being championed by our enterprise support organization, Collaborative, trying to innovate around sustainably funding enterprise support organizations. In addition, we use the findings from these reports to drive conversations with government, with other catalytic capital providers in a number of convenings. And one of them, the West Africa Deal Summit, was all about catalytic capital, and 400 people making commitments to move catalytic capital. It's in Nigeria this year in November. And so you can see on the slide contact information if you want to reach out. At that convening, we launched a Catalytic Capital Africa campaign. You can learn more about it at the URL on the slide, catalyticcapitalafrica.org. And if you're interested in any of our designs, collaborative design sessions, we have one coming up on the 5th of June. And I also wanted to highlight that in Nairobi in July, we'll be hosting the Africa Impact Summit together with national partners across Africa. And it'll be great to see some of you at that summit. I'm out of time, but one of the initiatives that was launched is more of a supporting initiative at the West Africa Deal Summit, was a deal source platform where investors, including catalytic investors, can meet local businesses that are matched to their selection criteria. So here are a few opportunities that have come out of moving forward with our findings. And thank you for this opportunity, and I'll hand over back to Frank.
Thank you, Amma. I'm a big fan of Amma's work. I speak about her all the time like she's my sister, which she is, but I'm a really big fan of the work that Amma is doing. So for everyone who's on the call, please, if you've got any questions to Amma, please put the question in the chat. Amma, quick question from Kuda. She's keen to understand if there are some cost-effective mechanisms for currency hedging. Have you been able to unpack any?
So currently, we see that funds will hedge, for example, by investing in businesses that are exporting goods or services, because then the incomes are coming in foreign currency. We see some solutions for DFIs, like the TCX sort of program that DFIs that are investing debt can tap into. But beyond those, we don't see affordable currency hedging solutions. And that is going to be a big barrier for capital that needs to have a return, because the devaluation is extreme. But we do see people hedging by choosing sectors that are, they hedge by choosing a sector that is less prone to currency shock.
I guess that's one of the joys of also trying to unlock local private capital, like from pension funds, because then you don't have to worry so much about the Forex exposure that you have. And that's when you spoke about your opportunities, I thought that was really interesting. So one last question for you, Amma. When you look at the lessons you learned from this particular process, what is the biggest surprise in terms of engagement from the field coming from this work? And what is the most urgent need and opportunity that you see?
So there were no big surprises. Catalytic Capital was moving in Ghana and across Africa, quite similar to everywhere in the world. The thing that is needed most is innovation, intentional innovation, and being deliberate about designing catalytic structures that are solving a big actual problem that people have. And I think there's a place for more place-based catalytic capital investments. For example, focusing on a single country so that you can get to a critical mass and actually see change at scale, or begin to see systemic change in one place. In terms of the sort of opportunities I see, or some of the things in the future, I would say that pension funding is is really an opportunity across Africa, and we need to figure out how to do it profitably, so pension assets are secured, and how to do it well. And it's been great to partner with people like AVPA around thinking through solving that problem, and we look forward to doing more.
Indeed, Amma, indeed. In fact, a big chunk of the work we're doing in this space is about unlocking that. There's $1.1 trillion sitting in dormant capital on the continent, pension funds, insurance companies. That is very much in line with the work we'll be doing in Catalytic Capital. So thank you, Amma. Remy, Austin from Open Capital, we're really keen to hear what you learned as well. So over to you.
Thanks so much, Frank. And just to confirm, am I just doing my quick intro or am I jumping right in?
Please do your quick intro and then jump right in.
Okay, great. So my name is Remy Olson. I'm a senior project lead at Open Capital. We are a management, consultancy, and financial advisory firm focused on sub-Saharan Africa. I'm based in our headquarters in Nairobi, Kenya, but we have 7 offices across the continent. We're up to 170 plus staff after being founded in 2010. And really, we work with a wide range of clients, ranging from small SMEs and startups all the way to large corporates, investors, development partners, and the public sector to really help all of our clients identify their challenges and then come up with tailored solutions to help them grow and raise capital. And so what we did with C3 is something that we do a lot on, right? So helping increase access for SMEs across the world. So we focused on catalytic debt. And what we really did is we did it kind of with 2 different lenses. And so we looked at this from a micro and a macro level. And so I'll get a little bit more into some of the macro details and wider industry trends that we've seen. But what we really want to do is also focus on the individual. So what you can see here is we focused on 6 SGBs, as we call them, so small and growing businesses. So companies that are commercially viable, 5 to 125 employees with significant potential and ambition for growth. So revenues less than 2 million, but looking for financing of 100K plus. So what we did is we talked to these individuals. Sorry, if you can just go back quickly. Yep. So we talked to many different entrepreneurs, and we talked to SGB owners kind of every day in our line of business. And so during this engagement, we focused on these 6 amazing entrepreneurs. So across the agriculture and healthcare sector in Ghana and Kenya and Uganda as well. We got just a lot deeper into their day-to-day and what some of their key market barriers are for being able to access finance. And if they were able to access finance, really how much impact could they achieve? And what does that look like in terms of ROI for the investors? So just very briefly, if we look at Josephine, who created Olive Link Healthcare here in Kenya, with just 70K in patient capital, she'd be able to provide baby care boxes for various newborn products for over 2,000 expectant mothers, which will be able to take better care of their babies, keep them healthy. But that also includes the launch of several new pop-up clinics, which would be able to create the revenue streams to ultimately have that ROI for investors. So it's a great example of with just 70K, the massive amount of impact and ROI that you really can accomplish with more patient capital. Next slide. So what does this look like from the macro bit? So we just saw this figure in the last presentation. The IFC number estimates that there's about a 331 billion financing gap for MSMEs across sub-Saharan Africa within the 44 million formal SMEs. And so what we wanted to do is focus just on healthcare and agriculture, again, to make a lot more focused approach to our overall report and just journey here. So within agriculture, we were able to calculate that there's about an $82 billion financing gap. And healthcare, there's about a $14 billion gap. So sorry, there's a slight typo underneath the healthcare bit. And while not realistic to fill the entire financing gap, but if you are able to fill this for both these sectors, that would create 21 million jobs in the ag space, over 800,000 jobs in healthcare. It would allow to be able to serve 234 million more farmers across sub-Saharan Africa, and 14 million additional patients in the healthcare sector every single day. But again, not realistic to really be able to fill this gap overnight and fill the entire financing gap. So we wanted to look at more of a ramped up approach of what happens if we can actually collect and raise $1 billion of catalytic capital across the entire globe for sub-Saharan Africa on an annual basis for 10 straight years. So still a high amount of capital to be able to raise, but much more reasonable when you look at the amount of capital raised on an annual basis. So if you were able to raise that 1 billion over 10 years, you'd be able to serve 29 million more farmers. You'd be able to buy 1 million medical devices to be able to be used in health centers across the continent, and create almost 600,000 new jobs in the healthcare sector. And the way we calculated this was we talked to numerous different SMEs and SGBs, and we said, how much do you need? So if you raised 100K, what's the impact you could do? And then we took those numbers, we kind of combined them with several different inputs, and then we extrapolated that across the entire financing gap. And so what we really found is that with this patient capital, the ROI might be longer for some investors, but you're building stronger, more sustainable businesses, which really de-risks the future investments and helps create really strong longer-term financial investment returns for financiers. Next slide. So after talking to entrepreneurs, after talking to a lot of the different program heads that we have here at Open Capital that work with SMEs and are trying to raise capital, and we really focus on access to capital. So we had all these conversations, we talked to funders, and there were 6 main challenges that really came across. So what we did is I've listed out the 6 here. And if you look in our report, what we do is we detail each of these different challenges, and then we specifically talk about how this challenge hurt one of our 6 entrepreneurs while they were trying to raise capital. So again, it talks about a more industry-wide challenge, but then goes into detail and makes it very personal in terms of how these different entrepreneurs really faced here. So going quickly through these, so there's a narrow and restrictive definition of how to measure sustainability and impact. There's often investors need to see in order to get approval on an applicant for a loan, but every company is different, every impact style is different. So having a little bit more flexibility there will be able to be much more inclusive from the lending front. The second is that the market lacks alternative debt products that provide medium to longer term patient capital. So a lot of the debt products you'll get a lump sum up front, and then you're supposed to have an ROI in 1 to 2 years because of the amount of upfront capital, which has a lot of limitations. The third is around limited long-term non-financial support. So we looked at technical assistance and how non-financial support can really help companies use the capital, grow, and scale. The fourth is probably one that people have seen a lot of. So high collateral demands for asset-based financing really hurt small businesses that don't have these larger kind of cash-based assets. And these really hurt demographics like the women and youth. The fifth is really around lack of innovative financing models. So things like invoice factors or other ways to be able to provide capital. They're starting to pop up, but not super prevalent. And then last but not least, this one's a little tricky because you obviously have to have very strong due diligence, especially with working with kind of SME lending. But the process does take a while. And this came out in a lot of our conversations. So it's easy to get deterred when you have an 8-month due diligence process with an investor, and it doesn't lead to any capital, and you have to create all these different documents and things like that. Next slide. So what does this look like? What's the actual call to action? How do we overcome some of these kind of systematic challenges. So what we did is we broke it down into here's what catalytic debt providers can do, and here's what more general and LP funds can do. So all of these components are kind of great to have. You kind of need one or two if you're going to set up a catalytic debt program. You don't need all of these, right? So what we looked at is in terms of catalytic debt providers, providing first loss guarantees or sub-oriented roles in a fund structure will really help incentivize more traditional lenders. So how can you partner with maybe a DFI and then a more standard kind of impact investor to be able to de-risk by going into investments together? How do you extend non-financial support over the lifespan of the catalytic debt instrument? So SMEs have their priorities change on a day-to-day basis. So when they get 100K upfront in day one, they might need to use that kind of month 6 on something else. And so being able to work with them and be able to provide them support to how to use capital along their growth journey is really, really important. Incorporating innovative models such as pay-as-you-go is really critical because it helps reduce upfront CapEx for SGBs and allows them to slowly make payments towards the ownership of assets, which will only kind of help their longer-term sustainability and just their overall financial health. And then very similar, kind of helping reduce some of those massive upfront CapEx costs, being able to crowd in more providers that are doing fractional leasing, renting options. We're seeing this in the infrastructure space and a lot of kind of equipment building and things like that, but less in the ag and healthcare space. And again, being able to access shared equipment will be able to help ROI for investors, but also be able to really cut down on some of those major upfront costs that are just not feasible for SGBs. And then lastly, but just going into some of what the more general LP partners can do is really, really evaluate what your impact strategies and targets are. So don't hurt an SGB if they're going for depth over breadth of impact. So if they're really, really focusing on their one community, maybe it won't have the larger scale and impact that an impact investor or some other kind of more traditional investors might be looking at, but be flexible in terms of depth or breadth of impact. And then providing follow-on capital. So don't just provide lump sums up front. Do it in really predefined tranches that will be, that will be released based off of hitting certain metrics. So you might have to reach X amount of clients, or you might have to implement a new product before you get the next tranche. But having that will be able to have companies leverage their specific needs with that money at the right time. Thirdly, just leveraging standardized sector-wide bankability metrics. So this one sounds like it's kind of counterintuitive to the first point around reevaluating your impact strategy, but it's leveraging enough of the standardized processes out there to be able to make due diligence a lot more straightforward, but while keeping your definition of impact a little bit more open and a much more customized. And then last but not least, more innovative TA mechanisms. So by able to give businesses TA packages kind of across the journey will be extremely beneficial for all the parties involved, because it means they're allowed to be able to use the capital when they need, be able to get the support of how to use that capital based off their growth journey, and be able to help circumvent certain budgetary constraints that might not have been the case if they had to use all of the TA immediately right after disbursement. So I know I've kind of gone through that fairly quickly, but we're seeing a lot of this in the market, which is great. So companies like Acumen, AgDevco, they've been releasing a lot of more patient capital, and the results have been pretty apparent. So we're seeing a lot of great progress and hoping that conversations like this can continue to push the envelope. But yeah, thanks, Kevin.
Thanks, Remy. That was pretty cool. And I'm seeing the common threads from what Amma presented earlier: the need for innovation, the need for non-financial services support, so on and so forth. We'll come back to questions at the end, but I have one question for you. Just if you can answer it as briefly as you possibly can. So just based on your experience with the SMEs engaged in this study, what are your reflections on how investors can best work to identify the needs of entrepreneurs vis-a-vis Catalytic Capital? And do you have some strong allies in the work that you've done so far?
Yeah, I mean, to understand their needs, talk to them, right? So they know their issues the most. They know that what they need and how they can be most supported on a day-by-day basis. So providing that tranche capital I talked about, being able to help them de-risk that for investors by having certain milestones, and really tailoring the money for their specific needs. And so having that conversation with them on a consistent basis, so you're not just giving money that maybe is not going to the right areas of their business. And I think in terms of who we're seeing as allies, there's allies across the ecosystem. Tons of people on this call are allies. So we have actors that are helping kind of some reduce that upfront financial burden. So some of the equipment pay-go that we're seeing pop up, donor-funded TA programs have been absolutely massive in terms of their impact in helping companies raise capital. And then we're seeing more and more financiers doing some of these more innovative programs. So accepting longer ROIs, invoice factoring, like I talked about, DFIs providing first loss. All of these examples that we included were examples that we've already started seeing in the ecosystem, which is fantastic.
Okay, awesome, Remy. Thank you so much. There are two questions in the chat for you, one from Thomas Kimani and another one from Ngu. Marosho, if you can please just respond to them on the chat, that would be awesome. And for the audience, Stacy is putting in the chat links to the research reports from the respective speakers. So please feel free to open those links. So Carla, over to you. We're really excited to hear what Aseli has been doing in this line of work.
Great. Hi, everyone. I will start off by apologizing for my voice. I'm at the tail end of a cold and I'm still waiting for my voice to get back to normal. But my name is Carla Legros and I'm the head of product at Aseli Africa. And I'll be taking some sips from my dawa so that I can get through the presentation. So I'll tell you a bit about Aseli. So Aseli is a market incentive facility that aims to mobilize additional capital into high-impact agricultural SMEs. We offer financial incentives to commercial lenders to reduce the costs and the risks associated with issuing loans to high-impact SMEs. So I'll tell you about how Aseli got started and how we use research and data funded by C3, the Omidyar Network, the MacArthur Foundation, and the Rockefeller Foundation to inform how we design our incentive program at the start, and also how we've adjusted it over time to meet the realities of the market or to help accelerate lending in key impact areas. So the concept for Aseli emerged from a dialogue from impact lenders across the world. And they were talking about the challenging economics of lending to agricultural enterprises, particularly in sub-Saharan Africa. So as you know, agriculture in the regions is predominantly smallholder-led, but agri-SMEs play a critical role in linking those smallholder farmers and their on-farm produce to buyers and consumers. But the challenge is that 3 out of 4 of them lack access to formal finance. In fact, only 5% of commercial lending was going to the sector. So when we probed into the reasons for this, we learned that the risk in agri-SME is at least twice what it is in other segments. And also the returns are significantly lower, about 4 percentage points lower. So lenders have plenty of incentives to put their focus elsewhere on other sectors. So with these findings on the table, the concept for Aseli was around using catalytic capital to share in the risk that lenders face and also to improve the returns so that we could make the agriculture sector more attractive for them. When we spoke to donors about this, they were really intrigued because this was a different way of using catalytic capital, because we weren't aiming to provide funding for onward lending to agricultural enterprises, but we wanted to tack on this catalytic capital to lenders' existing core business. But at the same time, even though lenders were intrigued, they were also skeptical. They were worried about basically giving funding to commercial lenders to do what they would have done anyway. So how could we make sure that this catalytic funding would actually help to catalyze additional capital, and also generate impact. So with the help of the institutions that I mentioned earlier, like the MacArthur Foundation, Omidyar Foundation, and eventually C3, we embarked on a journey almost for 2 years to gather data so that we could identify who would benefit from the incentives and how much. And the kind of data that we were looking for was essentially largely proprietary data. We wanted to know how many loans lenders were making already to a specific subset of agricultural enterprises. And we wanted to see the characteristics of those loans directly so that we could figure out and run some calculations on what the cost of originating and monitoring those loans were and what the returns were. So as you might imagine, we encountered several challenges because banks are not willing to share that kind of information. So we would host small group events, or we would engage with them one-on-one to explain the concept for ACELI and also to make these data requests. It took a lot of time and in some cases multiple years with some lenders. But once we started to build confidence about the model with funders, that then led us to build confidence with the lenders themselves. And so once they started to hear that we had donor funding committed for the ACELI model, they were more willing to share some of the data that we were asking for. But then beyond that, there were other challenges or hurdles that we needed to clear. Once we had access to the data, the next challenges were around ensuring appropriate data protections because we're engaging with borrower level information, and also harmonizing the data across lenders so that we could make, the analysis useful for us and meaningful. Because as you might imagine, in some cases, lenders characterize information differently within their institutions. Now, let's move on to the next slide. So we have here, you can keep clicking through. Yes, and click again. So we learned that agri-SME loans were unprofitable for many lenders. The risk was twice as high as I mentioned, and the returns were considerably lower. But even when lenders had access to guarantee programs, those guarantees were often not sufficient to cover the operating costs. So we use that information and a lot of the data that we gathered from the research to come up with 2 products. The first is an origination incentive, and the second one is a portfolio first loss cover. Because we were thinking, what if we could offer catalytic capital for impact? So basically an impact revenue line so that we could boost the returns on these agricultural SME loans and essentially make them more attractive for commercial lenders. So I'll quickly tell you a bit about the ACELI product. So the first one is the origination incentive. So what it does is it provides a transaction subsidy so that lenders, basically to top up the revenue that lenders earn from the interest and the fees. We've seen that the additional funds can fundamentally improve the returns on agri loans, especially for smaller ticket sizes. I'm talking below 50,000 USD. So that's product number 1. The second one is our portfolio first loss cover, which is designed to absorb the higher systemic risk in lending to the agri sector. We offer an average of 5% coverage per loan, but the difference with ACELI's first loss cover is that it accrues at the portfolio level, such that lenders can draw down on the entire amount that they have accrued in the case of any default in the portfolio. So in the last 3.5 years, we've paid out incentives on about 1,900 loans with a total value of $177 million and at a leverage ratio of about 10x. All those loans have gone to high impact businesses that create jobs in rural settings and that integrate smallholder farmers into their supply chains. And most of the enterprises also are gender inclusive, promote food security, nutrition, and climate resilience. We're seeing so far in terms of lessons, that lenders are taking up the incentives, but it takes time, especially for tier 1 large banks. So probably right now, our sweet spot is actually tier 2 banks. tier 2 banks see agriculture as a pathway to growth, whereas in tier 1 banks, agriculture is competing with many other sectors. And often we're seeing that there's a disconnect between what leadership is saying in the larger banks. They say they're interested in agriculture, but there's a big difference with the operational reality, whether that's what products they're offering, their team setup and their team capabilities, or the internal alignment between the lending team and credit risk and treasury. Sometimes there's a real gridlock in doing agricultural loans. So we've been focusing a lot more on behavior change. We've realized that we need to pair the incentives with capacity building for lenders around developing an agri strategy, around solving some of the gridlock and internally, and also activating their branches. So we're investing much more in that. And a lot of it comes from the findings that we collect through this annual research that we've been running. And C3 supported us on our first and second year reports. But we run this every year and collect information so that we can figure out, are the incentives still well calibrated to the market, or are there tweaks that we need to make so that we can advance lending in certain areas? And essentially, we've learned that it can be really powerful to take a pull approach. We're not pushing lenders to do this. We engage with them, and we prioritize lenders that are already interested in agri, that have already been doing something, and see the agriculture sector as a fundamental key part of their growth trajectory. And for some of the larger lenders that tend to have less interest, we're actually seeing that over time they're starting to come to us and talking about and asking us, how do we get involved? How do we become part of the ASCELI program? So I will pause here and take some questions, and then otherwise hand it over to you.
Carla, thank you. And I'm glad your voice held up a bit. So you need to share the recipe or whatever you're taking. It might help a lot of people. So interesting about the 10x leverage. Many people don't think that is possible. Do you have were you surprised by that 10x leverage once you got to the point where actually that's what you're delivering?
We were actually aiming for higher, but we basically set a baseline of around 10x, and it shifts from time to time. So, for example, in the last year, we've adjusted the incentives so that we're basically giving more incentives for loans to women-owned businesses, youth-owned businesses, and climate-smart businesses. So, in some cases, we've had to make trade-offs and see that leverage go down. So that we can catalyze lending in those areas. And we're about to launch a new round of incentive adjustments. And we've now set for that round a base level of 3 to 4x. So overall, we can still achieve around 8, 10x, 12x in some cases, but in some cases we have to make significant adjustments.
Okay, I'm curious, how much higher were you aiming when you said you actually were aiming higher?
We were hoping for 20.
And
in some cases we do achieve 20, but not always.
Yes, but I'm encouraged by that, because if you look at the kind of capital we need to mobilize for Africa, we've got to be audacious and ambitious. And I think the question is, what needs to be done to move from 10 to 20? And that'll be interesting to watch how you guys make progress towards that end.
Likewise.
Yes, exactly. Okay, excellent. Thank you, Carla. Thank you for your questions. We've got a couple of other questions that are in the chat. Carla, if you can, please look at them. Let's move on to Kirsten to talk about what's happening from the Bank Center side and Investor Zurich. Kirsten, over to you.
Wonderful. Well, thank you so much. I'm glad to be here with all of you. This is sort of a complementary, if a different investigation into Catalytic Capital. We were really curious for this study, which was a collaboration between the Initiative for Blended Finance at the University of Zurich and the Bertha Center and Roots of Impact, to sort of flip the script, if you will, on the concept of catalytic capital. we're usually sort of, think of that as a supply side term. And there's a set of assumptions that come along with, strategizing and deploying catalytic capital from that perspective. And so what we were really interested to do in this study was to have the opportunity to hear directly from entrepreneurs about the experience of receiving that catalytic capital and whether it did, in fact, act in a catalytic way for them, or whether that was more sort of the perspective of the supply side. So if you can hop to the next slide, that would be wonderful. And so what we did was we sort of found a set of entrepreneurs. About half of them were from sub-Saharan Africa, but we did also speak with entrepreneurs from South Asia and Southeast Asia as well. So this is a little bit more of a sort of diverse perspective. But we took the time to find entrepreneurs who we knew had gotten what we would all call from a supply side, some catalytic capital at an earlier growth stage of their business. And then we had in-depth conversations with them about what it meant for capital to be catalytic or otherwise for them. And so this really sort of led to kind of a more definitional approach to catalytic capital, especially relative to the presentations that we've heard prior today, though especially a lot of the challenges and opportunities that Remy brought up, you'll see really resonate here with the definitions that we heard from entrepreneurs. And one particularly interesting piece of this feedback was that there is a difference between what is actually catalytic and what's merely useful. And so while the intention might be to be catalytic, there was really interesting differentiation for entrepreneurs that we spoke with about the difference between those things. And what we found is that catalytic capital varies by instruments, enterprise stage, and the relationship that entrepreneurs have with their investors. So entrepreneurs describe catalytic capital as coinciding with a variety of actions. Those are things like sharing diligence, bridging rounds, financing, experimentation and scaling, signaling, and legitimacy. And catalytic capital also has a variety of attributes, including occasionally being concessionary, but always flexible, long-term, and risk tolerant. And also there are a variety of instruments that entrepreneurs associate with being particularly catalytic, including convertible notes and loans with concessionary terms and technical assistance paired with it. They also told us that what's catalytic sort of varies over time, if you will. So both with the enterprise's stage, whether they're early or growth or mature stage, and as well as catalytic capital that's able to be blended both within a financing round and over time more broadly. And then finally, we heard that catalytic capital really varies with the relationships that entrepreneurs have. In particular, there were different roles that were played by impact investors, non-impact investors, and foundations who were providing support to entrepreneurs, and that a lot of that hinged on also challenges that they experienced through those relationships as well. And then finally, investor and funder support as well was key. So if you could go to the next slide. We really found that investors can contribute catalytic value to entrepreneurs through making introductions to other field level resources and investors, and really heard over and over again about the role that investors can play in collaborating, in particular, leading around, sharing diligence, simplifying and streamlining that process and bringing other investors in is incredibly catalytic for them, as well as providing capital that is, as I mentioned prior, flexible, efficient, patient, and really key for them in early and growth stages of their business. as well as capital that's structured to incentivize additional capital, in particular through things like matching, making a statement that they've already, made a commitment of a certain number of dollars and incentivizing other investors to come into the round as a result of that. Additionally, capital that's blendable both in a round and over time through, reasonable terms and facilitated by grants. It was really interesting that, entrepreneurs don't think about their businesses necessarily in terms of rounds, but talked about the interplay between capital and strategy over time. And so, the role that Catalytic Capital plays is really situated for entrepreneurs in that capital and strategy broader conception of their financing. So again, taking the role or following that of a clear leader in an investment round and sharing their diligence was something that was mentioned many times, as well as providing this long-term innovation support through grants to experiment and innovate, especially because as entrepreneurs, told me several times, innovation isn't necessarily something that investors want to finance, but it is really key in early and growth stages to be able to continue to innovate, both with regard to the impact perspective and the actual underlying business model, and having support for that in the form of grants, which we wouldn't normally necessarily call a catalytic investment, plays a really important role in the ability of other capitals to be catalytic. So if we can head to the next slide. So this was, sort of an exploratory set of conversations. And so we weren't able to sort of generalize with, a whole lot of specificity. But toward the end of the report, and you can go in and find more detail, we did a bit to sort of align the different instruments or structures with particular actions and investor types, especially as they relate to the growth stage of an enterprise. And so you can see in this, in some examples that we have here for how investors can be catalytic according to the definitions of the entrepreneurs that we spoke with. So tried to zoom through that, and I'm happy to answer any questions anyone has.
Thank you, Kristen. Really fascinating. And, I don't think we do enough of this kind of academic research into Catalytic Capital. What's your level of experimentation around this subject? Do you think we're doing enough on the continent? Do you think there's still a lot of room to be done? And if so, what are the things that you think we need to do better?
I think that's a great question. I think that the level of specificity that we've seen from, the other speakers tells us that we're learning a whole lot about how Catalytic Capital can and is showing up in Africa. But I think there always is, more opportunity, especially as you mentioned, sort of at the definitional level, and to sort of slow down and, be sure that we're, having the same conversation between entrepreneurs and investors, and really being clear about what that means to everyone. So.
Okay. And Kirsten, is there anything when you talk about the kind of research that we need to do and the learnings we need to carry forward that we need to be having with policymakers? How do we bring the policymakers to make this space a lot more amenable to us being innovative with that kind of risk capital and credit capital that we're moving forward?
Yeah, that wasn't really within the purview of this research, because I didn't hear a lot about Catalytic Capital from, policy in this sample. So I think that probably some of the other speakers would actually probably be better qualified than I am to attest to that. I have to, take a position of humility on that. Yeah, I would welcome others to jump in on that.
Okay, we'll come back. I'm sure that there'll be a few more questions because we'll have a Q&A session at the end. So just to make sure we go through all the speakers, and then we can consolidate the questions at the end. Alexis, over to you, and tell us about the work you do with INP.
Thanks a lot, and hi everyone. So my name is Alexis. I'm working within INP as a finance director. Before going into the key highlights of our presentation and of our report, I will briefly present INP. INP is a pioneer impact investment group dedicated to support sub-Saharan small and medium-sized enterprises. We currently have a bit more than 400 million USD under asset management that are deployed by our team based in 10 African countries. And very briefly, our mission has always been to go where others don't go by financing SMEs that are the kind of the missing link of African economy in the most fragile and least developed countries, just in order to support the growth of entrepreneurial ecosystems. So we have several tools to do so that are tailored to the needs of African entrepreneurs in order to basically maximize their economic, social, and environmental impact. We can do that through direct investments, through fund activities, through seed funding programs. And we're also trying to promote the emergence of entrepreneurs by strengthening the ecosystems they operate in. And obviously, more than the impact that the entrepreneurs we support have, our goal is also to demonstrate the essential role of SMEs in the development of the continent. And this work that we've been doing thanks to the C3 initiative is part of our advocacy program, of course. And the goal of the report we work on was to kind of propose ourselves as a case study to demonstrate the effectiveness of Catalytic Capital in supporting African entrepreneurs. So we shared insight that we gathered thanks to more than 250 SMEs that we supported in order to offer a recommendation on the ways to accelerate and expand the use of catalytic tools. So the key insight and the key research consideration that you can see on that slide and that come out our report. And by the way, we also did a very short video because we wanted this demonstration to be as pedagogic as it can be. The first one is that we feel like what we've done over the past 20 years kind of demonstrated the long-term impact of financing SME through Catalytic Capital. We feel like the private equity tool is a good one to support entrepreneurs to achieve financial sustainability and ensure the longevity of the impact that we create. It also allows to have a strong additionality. And that is reflected in the impact thesis of what we do, which is to support the emergence of African entrepreneurs in frontier markets. 89% of our companies are run by African entrepreneurs. We also want to create decent jobs and direct employment grow by 50% since INP investment. We aim at densifying the local economic fabric, ease access to essential goods and services, promote gender equality, and of course, fostering sustainable growth. What we went through with this work was that the portfolio company that we supported did perform very well. Out of the 250 SMEs that we study, we felt like the financial performance of this company was very good. Over 5 years, they tripled their turnover. They multiplied their EBITDA by 4, which is quite impressive, and even more impressive given all the external factors that they face when working within the African environment. And I'm sure we all have in mind that the costs of fundings and access to funding is limited, infrastructures are challenging, recruitment obstacles are often there. So there are many expenses that are linked to this environment they're working and the level of formalization they're working. This very good performance and operational performance at the level of the SME, however, is not always translated into a good financial valuation of the SME we invested. And there are many reasons for that. Well, first one is that the market condition investors operate in are challenging. We are investing in SMEs that in markets that where the level of liquidity is quite low, so we have limited exit options. Sometimes we have to do premature exits because we are running closed-ended fund and we have timing constraints that force us to exit from our SMEs very soon. Currency depreciation are also another challenge that we face. And the last one, which is the most challenging one to address for us, is the fund management costs that occurs when we run our businesses. The costs are pretty high when compared to the unit value of the transaction, and that has a knock-on effect on the net profitability of the investments for our investors. The third conclusion of our report was that we wanted, of course, catalytic capital providers to increase both quantitatively and qualitatively. We felt like not enough was existing, and sometimes there are big amounts that were announced, but that struggle to reach frontier markets and to reach actual SME. And we feel like it's partly because of the lack of flexibility that we see in the financing options that were proposed. In many cases, actually, the standard of the funders were based on more developed markets and were not suited to the needs of emerging markets. So that's kind of the conclusions that we draw, and we propose some recommendation on what funders could do in order to make their own funding more efficient, and a lot comes with the flexibility of the terms. The first one being the fund lifetime that they propose, or the evergreen structure that they would be willing to finance. Another one could be the grant support that is needed. The guarantees, of course, is a key topic that has been already discussed. And we also felt like, as a fund manager, we could also improve the way we demonstrate and we communicate on the impact that we have. So that's basically the main conclusions of our report. What is new since we published it, or since we started to work on it? Well, on the NP side, we continue to develop a flexible investment tool for fund managers and for SME. The last program that we now advise is the Mastercard Foundation Africa Growth Fund, which is which aims at financing African investment vehicle with a youth and journalist investment principle, and that accepts a high level of risk and kind of unconventional terms to target first-time managers that are the ones that face the most barriers when they want to raise their fund. And we feel like there are other initiatives like this one that can bring more flexible investment tools to reach SME. And overall, through the few initiatives that we can see, we feel like there is a better understanding of the constraints by the investors, and it's both from DFIs or from foundations. We really now see people that want to propose first loss pockets, that are willing to support very risky models to create blending mechanism. And it also comes with the fact that those investors are willing to co-design the set facilities that they want to finance with investment managers and with the feedbacks of entrepreneurs themselves. And some of those programs can offer products that are more suited to the market needs than it used to be. As I said, the previous trend was kind of let's take. I mean, there are standards in the market and deal with it. Now they are okay to adapt a bit what they are doing with the market they're operating. And so that's for the positive trend. And I'll finish with the more challenging one, which is the overall context for impact investors. I think we all faced kind of a drop-off of available amounts that comes to the market because of the macroeconomic context, because of inflation, because of interest rates. And there are many reasons for that. the perception of risk overall is higher, and interest rates are higher as well. So I think that for us that are financing and that are raising funds in the impact sector, well, the gap between market rates and the rates that we can propose is increasing. And I think that's one of the biggest challenge that we have. And I think that explains why we shall all continue to better present the impact that we can have through those investments. Well, I'll pause there. And of course, very happy to answer any question you may have.
Yeah, Alexis, thank you very much for your presentation. But this whole issue of constraints in investment capital available is the big challenge we're all facing at the moment. Do you think availability of catalytic capital can actually help us crowd in more capital in these difficult times when fund managers and others are struggling to raise investment capital?
Definitely. Definitely. As I said, the level of risk perceived is quite higher than it used to be. So I think some of the investors shall take more risk or shall bring more flexible terms to the investment manager or to the entrepreneurs themselves, and shall be okay that it will kind of boost the financial performance of others, because everyone has its own mandate, and I think that's one of the key topics that we are facing today.
Okay, thanks. So to the audience, we're into the Q&A session. So if you do have any questions, please put them in the chat. I'll happily take them on. And as you're thinking through those ones, Carla, can I come back to you with a question on the back of your presentation? In the different countries you're now working on, how's engagement by country governments and the public sector influence outcomes for the users? And here we're talking about farmers and related businesses in terms of the flow of catalytic capital.
Sure. Maybe I'll highlight a couple of things. The first one is that we've done some research on central bank policies in the region to identify certain policies that, if they were tweaked, they could help improve the classification of loans to the agri sector, and also help to accelerate lending to the agri sector. So we have that paper and we're shopping it around with different governments. We're at different levels of progress, but we've realized that this is an area where we want to put much more focus. And so we're investing much more in that in the last year and in the years to come. And the second piece that I will highlight is, so Tanzania over the last couple of years has had a lot of the right policies to accelerate agri-lending. And we actually highlighted that in our year 3 learning report, which if you click on the link that was shared in the chat, it will also prompt you if you want to have a look at that. So Tanzania provided capital to a few banks at very low cost, and also mandated that they do onward lending of that capital to agricultural enterprises, and then also set a maximum of 10% in terms of the interest rate that borrowers would experience. And it's had a significant impact on agri-SME lending. If I remember correctly, agri-SME lending increased by 3 to 4x over the period of a couple of years. So we see the direct impact of enabling policies, and we want to encourage governments to also copy some of what Tanzania has done. But we are also interested in helping governments make more lasting change. So not just a program that is earmarked and then ends at a certain point, but to have kind of baseline policies that are conducive for the sector. So it's a roundabout way of answering your question, Frank, but I'm hoping this is informative nonetheless.
Yeah, I mean, what's encouraging, Carla, is that there are governments who are looking at solving these and being part of the solution and trying to make sure that they are trying to create the enabling spaces possible for what the efforts we're trying to pull together to really thrive and grow. So Kirsten, let me ask you this question. So what are some good ways, in your opinion, to enable entrepreneurs to get the most out of the catalytic capital that they receive? Are there ways we can promote communication and exchange between these two groups, often sitting at the two ends of a chain of players?
Yeah, I mean, I think that that's a great question. A lot of the entrepreneurs that were, really pleased with the relationships that they had and had successful relationships with particularly impact investors, really got introductions to other investors from a lead investor in a round, or from, a foundation that was both making an investment and a grant to them. And so really the effect of the networks that come through the investors, especially with really early stage enterprises, right, where their sort of capacity to take on a lot of capital is relatively limited, that those introductions from others who are in the space really plays an important role for them for connections.
Okay, that's good. And just a slight follow-up to that. Do you get a sense that our entrepreneurs have a good understanding of what Catalytic Capital is and the role it could play in making them more successful?
Yeah, I mean, that's a good question too, because part of it is actually in the design of the study that we didn't define Catalytic Capital for the entrepreneurs that we had the conversations with, and kind of on purpose, because as I mentioned before, that's a supply side, term. And so we knew it, they ended up in our sample or our set of conversations because we knew they had received money that we all would think about as being structured that way. But that wasn't really explicit in the conversations. What we wanted to know was what capital is pivotal for you in your journey, what allowed, you to do something you otherwise wouldn't be able to do, whether that's, experimentation or innovation in practice, or attracting additional capital, or meeting other investors. And so we sort of took the lead from entrepreneurs with regard to what it meant for something to be catalytic for them. So that word actually wasn't used all that often in those interviews.
So it's form of a substance in essence, is what I'm hearing.
Yes, absolutely.
Okay. So Alexis, my last question to you before we go to Umi for some closing remarks is, how ready do you think investors are to work with the insight that supporting SMEs can sometimes call for a willingness to accept lower returns and higher risks? What's the appetite? And how is your team presenting this idea to potential investors, engaging with Catalytic Capital opportunities?
Well, I think there is kind of a double trend. Some of the investors that were investing into so-called impact investing, but expecting a very high level of returns, and that thought it was, I mean, in some cases it might be, but that thought it was feasible to reach a high level of impact with a high level of return. And those ones are really hard to target for us working in frontier markets. The other category are the investors that start from the field and that try to understand the constraints and try to understand what those entrepreneurs do. And they are kind of reducing their expectations in terms of returns, or they are trying to bring an additional piece of flexibility in the terms that they propose. And those are the ones that we definitely target. And those are the ones that we feel are really understanding what is going on. And we kind of feel that this group is increasing slowly, probably not enough. We would not be there if it was the case. But we kind of see that trend that we, of course, wish should accelerate.
Okay, Alexis, I would love to, as AVPA, to work with you and try to see how we can grow that group, because that's really in the core of what we do. So very, very interesting to listen to that. To all the speakers, thank you very much for your comments. The audience, we're not done yet. Umi has some closing remarks, so I'd love to invite Umi to come onto the call. Umi?
Yeah, thank you, Frank. Yeah, big thank you to the presenters for sharing the work they've done and taking on this challenge of, encapsulating in 10 minutes the work that a team of many, many people did over a course of several months. And it is interesting to us that these projects all started in 2021 or so, got done over 22 and 23. The findings are so relevant and contemporary for all the work we're seeing around us today. I want to highlight that the Catalytic Capital Consortium is a learning and market development initiative. So our goal is twofold. It's both to increase learning, awareness, knowledge, and insights about how Catalytic Capital is being deployed, what some of the benefits are, where are the opportunities to do this better and differently, and how results have been observed in different sectors and regions. And also we want to motivate and inspire action by investors to deploy more of this capital, to deploy it more thoughtfully. And all of our grantees and many of you on the call, as well as networks like AVPA, are our partners in that effort. I think what you all may have noticed from seeing the broad range of sectors, regions, types of enterprises that were featured in today's presentations, that the need and role for Catalytic Capital is fairly broad. It is very deep, and what you can do with a patient flexible capital is in some ways highly successful. We looked at the numbers that Amma shared about bringing other funding in down the road, which is 5 times, 6 times more. And that is just one example. So I think noting that need and opportunity and basically knowing that if you're working on social impact anywhere, there is going to be a role for Catalytic Capital. And, it helps all of us to figure out that opportunity and identifying it as being different from a market rate investment opportunity early on. The other thing that we hope, 2 other reflections before I hand off to Frank to wrap up. One, also in a couple of the presentations, I think we want to make sure we highlight the role of the community and the enterprise, right? So as Kristen noted, a lot of our work is from working on the investors and their needs and helping them understand and do more of this kind of capital deployment. But at the same time, this needs to be grounded in what the communities that are being served by entrepreneurs need, and then the form in which those entrepreneurs really need this capital. So starting with the gap in the need first versus sort of what money we have on offer at the other end is critical. There's also a role for intermediaries such as INP and others on the call to step in and help them structure that offering that builds the connection between these 2 slightly different sides. Even though many Catalytic Capital providers are united in their desire to create impact over sometimes getting market rate returns, I think there is still a huge amount of work that needs to happen in structuring creativity and putting all of that, all of the different pieces together. And I would also like to call out a couple of synthesis papers that were done by our colleague Harvey Ko. One was put out at SSIR, one was put out in Impact Alpha, which take some of these lessons and learnings from these different evidence-based projects from the 14 grantees and partner projects in the cohort. I think Stacey's put those links in the chat. Thank you, Stacey. And that will give you a sense of some of the common threads of these different conversations. And I think what's really fascinating is that there are several elements that jump out about Catalytic Capital deployment and making that successful across all of these projects, even though they're really different, and each one of them came at it from a very different lens. The last thing I would like to say is I would just like to leave with encouraging all of you who joined us today to reflect on what you have learned in terms of how it can contribute to things that you could do in your work, that could influence ways you engage with other stakeholders. I think there was a question in the chat about collaboration and lessons. Yes, because we work in such challenging circumstances and there are so many elements that need to fall in place for this kind of capital to make a difference and for us to see the kind of impact we want to see at the end for the communities in question. it is very, very important to collaborate across multiple levels, to be clear about priorities and motivations, and to share, I think, transparently what we know about the opportunities and risks, so that learning can inform what others are doing. We've worked with the University of Cape Town and the Bertha School, as well as Roots Impact, which was part of the project that Kristen presented on, to develop a catalytic capital training, which is intended for investors that are beginning to take on these kinds of strategies and transactions. And I believe that Frank and AVPA are hoping to put out this training adapted to their market, to the African market, in the coming months. Please keep an eye out for resources, tools, learnings on our website. Sign up for the newsletter as well. If you get a chance, that will help you learn more about projects that are similar to the ones that we heard from today. So thank you, everybody. And Frank, back to you.
Umi, thank you very much. To Stacy, C3, and the speakers, MacArthur Foundation, thank you very much for hosting us and bringing us together in this, what we believe is a very critical conversation. At AVPA, the whole building and mobilization of Catalytic Capital is core and center to what we believe is probably the most effective way of mobilizing capital for impact on the continent. So you'll see us having a lot of emphasis on work in this space. As Umi has mentioned, there's a Catalytic Capital training program that's been developed by UCT and C3 that we shall be rolling out in Q3. So if any of you is interested in that program, please do get in touch. I'm going to put my email address in our chat, and my colleagues are also going to put their contact details. So that's one of the things we'll be doing in this space. Secondly, we're very excited to soon be launching a Catalytic Capital pool fund as part of the question around collaboration. We know that risk capital is hard to come by. So to help more and more of the players who are sitting on that kind of capital to do more work in this space, we're creating a pooled fund that will seek to provide more catalytic capital. We want to build this fund into about a $200 million fund in the next 5 years, seeking about a 10x leverage. And part of what we'll do with this fund is to really fund initiatives in Africa around innovative finance that can not only help provide proof of concept and evidence, but also, most importantly, crowd in private capital to the impact space. So we'll be looking to, in particular, unlock local private capital. We're targeting more so than anything else, the kind of institutional capital that's sitting as dormant capital on the continent. So if any of you have some really innovative and interesting models that you think could benefit from catalytic capital to help create the evidence or demonstrate the evidence or proof of concept, please stay in touch with us. This fund is very imminently going to be launched. We're hoping to finalize all the legal work this week. And in the next 2 or so weeks, we should be going live with at least some of the back-end staff. But we are super excited about what that could bring to the table as well. And then the third and final thing is, in line with continuing these catalytic capital conversations and communities and collaboration, we're doing our conference in Nairobi, Kenya, November 4th to 6th. There'll be a huge focus on catalytic capital. If you want to come and engage on not just panels, but also problem-solving communities and initiatives and workshops around this space, we'll be having a boot camp on catalytic capital. Please come and join us in Nairobi 4 to 6. It should be a super exciting time for all of us. I think you'll hear again from some of the speakers today. I definitely will be bringing them into the agenda for that conference. So there's a lot happening, but we're very much at the bottom end, and there's a huge need for us to increase our prominence and activity in this line of work. So without further ado, I want to say thank you very much for everyone. This has been really exciting. I think we're only at the beginning of stuff. I personally believe that Africa can provide solutions to a lot of the world's problems, from decarbonization to global workforce to agricultural productivity. And catalytic capital is at the core foundation of us being able to do that. So stay in touch, connect with us on LinkedIn and other platforms, as Umi has mentioned, and we shall be doing a lot more in this space. So thank you very much to everyone, and thank you for making time to be with us.